Hello, dear students. I am your course instructor of financial management. This is the chapter 1 of financial management. In this chapter, we will try to learn the following things: career opportunities available in the financial management perspective, what issues that you may face of the new millennium and in this dynamic changing world. Number 3 is forms of business organizations, and then we will try to learn the goals of the corporation. And in last, we'll try to understand what is the agency problem and what is the agency relationship while doing financial management. Actually, financial management is made from two words. Financial means related to finance, and management means how you are managing your finance. From which resource, in the simplest word we can say, from which resources you are getting your finance, from which resource, whether it is internal resource or external resource of funding, or whether is it debt or equity source of funding or any other type of funding, and how you are applying them to get a good return, how you are applying them, how you are investing them on the other side to get a good return. So it is called financial management. So what are the career opportunities in finance? Number one is money and capital markets. You can you can be a broker in a money market, which is called as a short-term market. Capital markets are where the funds can be taken for a longer period of time, such as bonds market. So capital markets, either you can work as an intermediary, or as an you can become a broker of that market, or you can start your business by becoming an investor. You can become an investor in these types of markets. So by learning finance, you can become a prudent investor, whether you are investing in a short-term market, on a long-term market, or real estate investment, or any type of investment which you are gonna in which you are gonna invest, and you have an interest to invest, but you have some prerequisite knowledge of that, how the prices are moved, and you can get the benefit of learning finance. Then you can become a financial manager in any type of financial institution, such like banks, or such like mutual fund companies or other trading companies, securities trading companies. So you can get the qualification of financial risk manager, or like CFA certified financial accountant, uh, which are the experts of doing financial management things. So you can run your own business to provide services independently to other related sectors, which are related to finance. So basically, um, you can adopt any type of the opportunity, or you can also do the work jointly by doing, on one side you are a financial manager of any company, and on the other side you can also work as an investor independently. So you can learn the finance by earning a handsome money in the future. So this is actually the future, and you can put your time, you can give your time to learn this subject, uh, to be handsome enough to get a good return in the future. So here is the thing to understand, to discuss, is responsibility of financial staff. What is the responsibility of financial staff who are working as a financial manager in an organization? So in the finance department, each and every worker should emphasize on how they can maximize the stock value, how they can maximize the stock value. The stock value means the share value of the shareholder. How can they increase by doing the following steps, by focusing on these steps. Number one is forecasting and planning. With the proper forecasting, by using the past data analysis, and on the basis of past data analysis they can forecast, and according to that they can plan some important things for the future, uh, that can maximize the stock value. For example, they can use the past data of the prices of any share price of any company, and they forecast that in the future there might be a decrease in um, there might be a decrease in the supply of supply chain management, or due to the disturbances of the coronavirus. So there are disturbances in the supply chain, the blockage in the supply chain. So the cost of the raw material will be increased, so their profits will be reduced, and the final effect will be on the stock value. So they plan to decrease their stock prices in the market deliberately to attract more investors. So that's one type of example. Second thing, investment and financing decisions. So from one side, if you look at the balance sheet, then in the balance sheet there are, on the left side you have assets, on the other side you have liabilities and or equity. So you are financing from this side, whether by taking debt or by floating the shares in the market. So you are taking financing decisions, and here you are investing in some, whether you're investing in short term current assets, or which are called short term or current assets, or you are investing in long term projects which are called fixed assets. So how much and how you are taking finance and how you are investing, so these are very important decisions to increase the market value of the stock prices of shares. Number three is coordination and control. So there must be a proper implementation of the procedures that must be followed by the department for a proper coordination between line managers, middle managers, and upper management, so they can take proper measures quickly and timely to implement their decisions. And there should be a proper control over all management policies and practices. Number four is transactions in the financial markets. So whatever the transactions are happening in the financial markets, they must look deeply into those transactions, and whether there are bigger players in the market or the short players as well. Sometimes shark is eating out all the small fishes in the sea. So the transactions are happening in the financial market. Sometimes the financial markets are crashing. So you have a deep insight of those transactions. You look into them each and every time. Look at the news, especially the business news, and then look at the trends. And according to that you have to decide what to do in the future. And as a financial staff, you're also working how to manage the financial risk. So there can be a business risk, there can be a credit risk, and there can be also a market risk, like the beta risk or beta movements. So all these types of risks must be managed efficiently to increase the share value of the stockholders. Okay, guys, the next thing to understand is the role of what is the role of finance in a typical business organization. So this is the basic flow chart of any business organization. Uh, there are board of directors and the upper management, then president, and they select the president, and then there are vice president of sales, vice president of finance, and then vice president of operations. So vice president of finance have two sub departments, like the treasurer department or the treasury, and the controller department. So controller department is providing information related to the accounting, like financial statements and which are ready to publish to the general public. Cost accounting, which is used for the management purpose, internal use, and tax accounting for the government purpose. So all these resources are providing accounting information to the vice president of finance. And on the other hand, he's also concerned with the finance department. So finance, the treasury, under the treasury department, they have a credit manager who is handling the credits of the company, and the inventory manager who is taking the control of the stock, and the capital budgeting director, who capital budgeting means how to invest in different types of projects, and they're making short-term or long-term projects. Okay, so all these things or all these types of information are also being provided to the vice president of finance, and he is also communicating this information to the president and the board of directors. He's also linked with the strong link with the sales and the operations manager. So finance, you can say uh, lifeblood of an organization. So if it doesn't exist, the organization will not exist. So properly management of finance through different types of different sub departments of controller and treasurer is important for the vice president of finance, so that he can take care into the matters and how they are actually controlling all the financing and investing activities, and how they are presenting it in the financial statements to the general public. So that's a very key post. Or we can also say the CFO, chief finance officer of any company. The effects of the new issues, or the the emerging issues, you can say, of the new millennium or the new century. uh, it's not about the new millennium. It's, we can say, the every new year nowadays has a different challenge. Even every new month has a new challenge, after this pandemic situation of the coronavirus. So you can observe that, even at the individual level at home, you are taking the online classes. So it's changing pattern all over the world. um, uh, that is changing from physical to online sessions or online classes. So in the same manner, the effect of changing technology, if some students are not good or equipped with how to how to effectively engage with the technology to have new resources of learning, like YouTube or a Coursera or some other modal technologies, or um, some type of other technologies which are emerging in these days. So the same is the case with the teaching pattern. Like, if the teachers are not equipped with the technology, how can they deliver their lecture to the students in a good manner? So for students, for teachers, and on the and in this, if we talk about the subject concern topic, then the finance managers, the the changing technology have a lot of concern um, about their future. If they want to be an investor or a finance manager, they must have to have cope with the dynamic environment of this changing environment, which is changing very fastly nowadays. New apps and new knowledge is emerging day by day. New researches are coming, so they must have a grip on all these types of things. Like, they must have to have get equipped themselves from the new apps, Oracle Financial, like ERP solutions, SAP. So all these things. Like, how can you work effectively from home, and then you can deliver your best. So, and by sitting at home now, you can also invest with the globalization of business. Now you can also invest not only in the international securities market, but also you can also trade internationally. So over the counter OTC market, you can become an international investor by investing in Nasdaq, or New York Stock Exchange, or somewhere else, or Bloomberg, or like any type of Standard and Poor Index or Dow Jones. So you can invest by sitting at home now. You must have a credit card or Mastercard, and then you must know the techniques how to invest in those markets. due to this globalization, you are changing, you are becoming, um, you're exposing yourself, I mean, from country to the world, to the whole world. So, and at the same time, you have to face the risks from all of the world, different types of risks like the market crashes or financial crisis or these things. So these are the new issues which are becoming, uh, on one side they are creating opportunities for you, and on the other side they have lots of risks that you have to handle. So we can say that if you can handle a high risk, then you will get a good return. So high risk, high return; low risk, low return. In continuation with the last slide, so we can observe that these companies are earning their revenues from overseas. So if you become an international investor, you can also earn a lot. But there are also risks, culture differences, or I mean the market movements. So you have to handle all those risks as well. So like you can say that the Coca-Cola company is uh, earning their 60% of revenues from outside, ExxonMobil 69.4%. Likewise, McDonald's is earning their 63.1% or net income of 61.7% from outside the world. So overseas there are opportunities and the threats as well, and you have to have the risk appetite to absorb all types of those risks. So if you can effectively handle all those risks, then you can earn a handsome amount of profit. Let's go through the basic types of organizations. Sole proprietorship, in which we have only one single owner, and partnership, in which we have the limit from 2 to 20 partners, or as it is it can be changing according to the country level regulatory environment. So it can be up to 50 as well in any country. So in the banking organization, it is considered as 2 to 50. But you can concern with the regulatory authorities notifications that expresses their opinions regarding that issues that are issued on regularly basis. Like in Pakistan, there is the regulatory body is the Securities and Exchange Commission of Pakistan, which describe that or the partnership is and the partnership is working under the Act of 1932, and it has different sanctions. You can go through it. So it varies from country to country. Okay, so corporation is joint stock company in which you have many number of owners. Uh, and there is also emerging concept in Pakistan that even a one single member can have a single member company as well, which he or she can register on her name, and then afterwards he can float the shares into the market if he decides to do so. He can collect the equity, he can gather the finance from IPOs or floating shares in the market. So one to many owners can join themselves, can pool their funds together to make a corporation. Okay, now let's go through some advantages and disadvantages of proprietorship, single owner company, and the partnerships. Advantages are ease of formation. It can be easily formed. There are no so much paperwork or difficulties. Subject to few regulations. They don't have to follow ICAP or SECP regulations at the same time. There are no corporate income taxes, so there is only one type of single taxation. Rather, on the other hand, in corporation we have to pay double taxation. Disadvantages are number one, difficult to raise capital. Yeah, banks hesitate to give capital to you because uh, um, on the basis of collateral security, you must have to have something to give the bank as a security or collateral. So If you have a good property, then you can get a loan. If you don't have, then it would be difficult. So in this way, normally the proprietorship or partnerships in the context of Pakistan, they are actually made from by taking loans from the friends or family members who trust in yourself. And normally the parents give money to their children uh, to start their own business by making 5 to 10 lakh or above than that investment to start a business, to start a new venture. So unlimited liability, yeah. If you cannot pay your loan to the banks or any other uh, type of you if you don't if you pay, if you get some loan from your friends or family members, if you are unable to pay back them, then if they don't forgive you, then they can claim on all of your property. Okay, they can claim on your assets as well. So it's called unlimited liability. It's a limited life as compared to corporation because it goes with your life. If you are ill or if you are not effectively managing the operations of the business, and who are there to manage on your behalf? So it has a limited life as compared to joint stock company. Now the next thing is, let's go through the advantages and disadvantages of joint stock company or the corporation. So it has the advantages of unlimited life. Even the owners changing, the board of directors are changing, but it keeps going on. It goes on and on and on in the coming years. Like you can say that Steve Jobs has died, but the Apple Corporation is still going on and on, and it's increasing their profits day by day. Easy transfer of ownership, yeah, you can sell your shares in the market, and whoever is getting the single paper of share, he will become the owner of that specific share of that company. Limited liability, you are only liable up to the value of your shares. Okay. And the ease of raising capital, you can, if you have a giant stock company or have good good standing position, good rating, then you can easily get the loans, the short-term loans, the long-term loans, or the debts or bonds from the market. Disadvantages is double taxation. One tax is applied on the profits, and the other taxes are applied then on the dividends the shareholders are getting. So it's a double taxation. Cost of setup and report filing, yeah, it costs a lot. Cost of setup, you have to make a good setup. So the joint stock companies have big offices, luxury offices, and report of filing. You have to file the documents and to the government. You have to publish your financial reports to the general public, to the tax authorities, and to other regulatory authorities as well. So it requires some cost. So all these types of these costs will be subtracted from the profits of the company, from the reserves of the company. Okay, students. The next thing is financial goals. What are the financial goals of the corporation? The primary financial goal is shareholders' wealth maximization. What is actually the shareholders' wealth, and how are you maximizing it? The shareholders' wealth is the value of the shares that are present in their hands. So it is the basic concern of every financial manager to focus on how they can increase the shareholders value, the share price. It means in the simple way we can say that how can they increase the share price in the market, how can they maximize the stock prices in the market. If the market price increased, then they can sell their shares at a bigger price. And on the other hand, on another side, how much dividend are they earning on each year's profit. So it is considered as the shareholders wealth. This is the basic goal of the financial management. The book we are reading, the basic goal would be, as you if you're working, if you consider yourself as a financial manager of a company, and your basic goal is to maximize the value of shares of the shareholder. Okay, the other sub objectives are the sub goals are, do firms have any responsibilities to society at large? Yes, the firms are the have a separate entity and their existence in the society, so they must do some good things for the benefit of the society. A complete subject like CSR, corporate social responsibility, is emerging very fastly nowadays in the whole world, that are reporting their separate CSR reports, and they claim in themselves they are planting new trees, they are giving charity to the uh, disabled persons. Like you can see on the KFC paper on the tray, you see that they are investing in different types of schools to engage in the activities how they can flourish the disabled children of the society. Likewise, other organizations are also investing different types of projects that can benefit to the society or the environment. Now, second, is stock price maximization good or bad for the society? Generally, the research says that the stock price maximization is good for the society because they take good measures and announces all those good measures that attract investors towards that specific organization, so the investors can have the trust, or they can build a positive attitude towards understanding of that organization. So generally, the measures which are taken to boost up the stock prices are good for the society. Number three sub category of that goal is, should firms behave ethically? Yeah, it is it is generally, and it is obvious that they must behave ethically in the society. They must adopt good patterns that do not hurt society. They must dump all their waste in a safe manner so that society people will not be hurt, and they must take measures, good measures, how they can boost the morale of the society, of the whole society. Okay, next thing is stock price maximization the same as profit maximization? The price maximization is different. Let's look into it into detail. No, these two things are different. Yeah, despite a generally high correlation amongst stock price and earnings per share and cash flow, but these two things are different. Stock maximization is different from profit maximization. Actually, the profit maximization can give more dividends to the shareholders, and by giving more dividends to the shareholders will increase their goodwill in the market, that will attract more investors to the market, and subsequently their demand will be increased in the market, and which will lead to the increase in the stock value. So it has some indirect relationship with the with the stock price maximization, but it doesn't have they don't have the same thing. The profit maximization can lead towards the stock price maximization. Current stock price relies upon current earnings as well as future earnings and cash flows. So I've already explained that the current stock price reflects actually the how much the firm is earning currently, as well as how much will they earn in the future. Some actions may cause an increase in earnings yet cause the stock price to decrease, vice versa. There are some actions that can be taken to increase the earnings, but they do not definitely they are not directly related to the increase in the stock price. We've already discussed it. Okay, guys, next thing to understand is agency relationship. What is actually agency relationship? And it is actually derived from the agent. So agent mean one person who is working on behalf of another person is known as the agent. So An agency relationship exists whenever a principal mean the main person or the boss, hires an agent to act on their behalf. Shareholders are the boss of organization, or they are the principal of organization. They hire managers to work on their behalf for the growth of the organization. So managers actually are working for the growth of managers are the agents who are actually working for the growth of the shareholders value. So principal or the shareholders are appointing managers, which are known as agent. So shareholders and managers, so the relationship between shareholders and managers is known as agency relationship. Shareholders are the principal and managers are the agents. One more type of relationship exists between shareholders and creditors. Shareholders are the principals and creditors are the agents. So creditors are working on behalf of the shareholders. Shareholders say that if you can take loan from these types of banks, then they become the creditors of the company or the financial institutions. They also give the credit to the company, and they also work on behalf of the company. For example, they pay their bills on monthly basis. They pay salaries to the staff holders on monthly basis. So banks are also working on behalf of the shareholders. So in that agency relationship, in these two types of relationships which exist between shareholders and shareholders and creditors, in this slide we will try to understand the relationship between shareholders and managers. Managers are naturally inclined to act in their own best interests. Okay, shareholders have appointed managers to work for the shareholders' interest. So managers should naturally work for because they have been appointed by the shareholders to work to increase the shareholders' wealth. But what happens? They are naturally inclined to work for their own interest. Actually, when they see that nobody is looking at them and their actions are not being noted by shareholders, so sometimes they work for their best interest. So these are the following situations which can be created or which are naturally created between this relationship. Number one is managerial compensation plan. If the shareholders are giving good compensation to the managers, they will work for the betterment of the organization. If the compensation is not good, then they will definitely work for their best interest. Direct interventions. If the shareholders are directly intervening in their matters, then it would be difficult for the managers to manipulate the things. If the managers have a threat of firing, then they will work for their interest before firing. Okay, because being fired up, the threat of takeover, the shareholders have a threat of being taken over by the managers because managers slowly and steadily purchase shares of the company. If they also become the shareholders and the owner of the company, and and by misleading their actions, they can take over the shareholders wealth. So it has a long stories in the past how managers worked for their best interest and how did they capture the organizations, especially small ventures. So it's really very good for the shareholders that they directly intervene in the matters. Okay, guys, the next thing to understand is shareholders versus creditors. Um, shareholders through managers, because managers are working as an agent on behalf of the shareholders, could take actions to maximize stock price that are detrimental mean which are not good, which are harmful to creditors. So what will happen? Actually, managers are taking actions to maximize shareholders wealth, but on the other hand it is teasing the creditors in the market. So what will happen? Actually, if the creditors get disturbed from these actions, so they can make difficult for you to get the loan in the market, and they can make the loans as expensive for you to do in the market. If you cannot easily get the loan from the market, then what will happen? If you cannot easily get finance from the market, and what will happen, your share price will go down because your goodwill will lose. You will lose some goodwill in the market. So in the long run, such action will raise the cost of debt, which is interest, and ultimately lower the stock price. Okay. Factors that affect stock price. What are the factors that affect stock prices in the market? Projected cash flows to shareholders. Okay, if the projected cash flows are higher, then the shareholders will get a good words of mouth to the market. And what will happen? It will attract more customers or investors in the market. The share price will go up. Timing of cash flow streams. So if the timing of cash flow stream of the cash inflows is good and you are getting good cash inflow, then uh, within a stipulated time, then your time value of money concept says that today's amount is better than for the future. If you are getting good amount of cash inflows in the future, in the near future, then there will be more customers in the market for you to purchase your shares. So it will have a positive impact. Riskiness of the cash flows. So if your cash flows are risky, I mean, there are more bad debts in the market, then it will have a negative signaling in the market, and your share price can go down. The basic valuation model for this is you can valuate your security by discounting from the future cash flows. CF mean the cash flow the first year divided by 1 plus K mean the cost of capital. For 1 year, you're discounting it from 1 year to the current value plus cash flow of the second year. It will be discounted to the present value plus up to so on CF and cash flow for the next period, and it will be discounted from the respective cost of capital, and it will be discounted to the present value. So all these uh, symbols can be combined together by using the summation sign from starting from T from first year, from the first year, and from the nth number of years, cash flow starting from the T first year, and it can be discounted to the n years. So this is the basic valuation model for discount for how you can find your present value of cash by using the future cash flows. So to estimate an asset value, one estimates the cash flow for each period. The life of the asset is n, and the appropriate discount rate. So this is the discount rate which is calculated by using the WACC, weighted average cost of capital. Throughout the course, we will discuss how to estimate the inputs and how financial management is used to improve them and thus maximize firm's value. This is the basic goal of the finance manager. Factors that affect the level and riskiness of cash flows. So what are the factors that are affecting the cash flows, the riskiness of cash flows? Okay. Decisions made by financial managers. What type of decisions? Investment decisions. If the investment decisions, like we are using the different type of projections, and we use NPV or RRR, if there are different types of techniques we will use in capital budgeting. Financing decisions, and how much you are taking debt and how much you are taking equity and how much you are using your internal source of finance, it will affect your financing decisions, especially the debt financing. Then dividend policy decisions, how much you're going to pay to your shareholders as a reward for their investment. So these three types of decisions can affect your cash flows and their riskiness. And the external environment is also there. For example, the recent example of the coronavirus and due to this COVID-19 pandemic situation, the cash flow streams are affected of many companies, not only in Pakistan but outside the world. So in the whole world, the external environment get disturbed due to this coronavirus. So external environments matter a lot to affect the cash flows of any company. So that was all about today's presentation of the chapter one, which we will discuss, which we have discussed from the first chapter of the Brigham book of financial management. Hope you will understand, and you can also give comments below this video, and I will try my best to give you the answers. Okay, take care. Bye bye.